Hey everyone, my name is Adrian and welcome to my channel on passive income investing. I'm pretty excited about this video. It's where I will show you my entire dividend stock portfolio, where I make about $1,000 a week in passive income from dividends alone. So the first thing you might be asking is why are you showing me this in a spreadsheet? Well, I'm showing it to you in a spreadsheet instead of directly my brokerage account is because my stocks are spread out between four accounts between my wife and I, so I can't really show it to you from the brokerage tool. So it's all consolidated in this spreadsheet. The second thing I want to go through is just show you how I organize everything. So the first part here, the first column here is the stock. So it's pretty obvious you have the name of the fund or the company, and if it is a fund, who manages the company. There's the stock symbol, and these are all hyperlinks because I've set the links to go to the company's website. So here you have the stock details. This is a pretty important section here. So I'll describe what the fund is. So as you can see here, income fund or ETF, etc. And in brackets, I will have the sectors. First of all, the sectors that this fund covers or the company covers, and then the region. There's the inception date. So if it's a fund, when the fund was created, as well as the management fee. The investment is how much money I put in. The weight is how much of this constitutes my portfolio. So this fund, for example, is basically 2.49% of my portfolio overall. How much shares I have, what my average share price is, what the dividend yield is. So this is important. It's the annual dividend yield or interest rate that I'm getting. Then there's a dividend frequency, so M for monthly, Q for quarterly. The annual dividend rate is here, so under annual dividend. And then you have the annual income, which is how much money I'm going to make with this fund for the year, and the monthly is just the annual divided by 12. So you can see here in the annual dividend, I have some colored sections. So green is usually for dividend increases. Blue is mostly just for comments or for funds that where the dividend varies month to month. So I just put a little comment there. And then also you have some other ones that are red color, which are dividend reductions or temporary suspensions. And as well at the top right, you have here the breakdown. So you see income funds make up 14% of my portfolio and almost 15% of my income overall. And you have the ETFs, split corps, REITs, and the regular stocks, which are individual businesses, which make up the most of my fund, obviously. So let's get started. All right, so starting with the income funds. The first one is called the EIT Income Fund. This is from a company called Canoe Financial. This is one of the crown jewels of my account. As you could see from the investment I made, I really like this fund. So this one goes back a long way. They created this fund in 1997. The yield is really, really good. It's over 10%, as you could see here. So it's one of my biggest money makers. It makes $146.50 a month. So this fund is really, really well managed. It covers a lot of sectors, so all the sectors of the market. That's why you see the mixed here. And the companies are mostly North American companies. So I really, really like this fund. The next four funds are from a company that also like called Middlefield Fund. So the first one is their flagship product or their oldest product called the Mint Income Fund. Same type of deal like the EIT one. So it's mixed sectors in North America. Also coincidentally created in 1997. Pretty decent yield of just under 8%. So pretty good. The next one is the Global Dividend Growers Income Fund. So this obviously focuses on dividend companies globally. So 75% in the US, 23% international. So some good exposure to non-Canadian dividend companies in this fund here. The next one, same type of deal. It's the European Dividend Income Fund. So just like the name says, it's going to be mostly a European dividend company. So you have the breakdown here: 70% Europe, 17 Canada, and 13% US. The next one is called the Pathfinder Income Fund, also from Middlefield. Very interesting fund because this one concentrates on fixed income or mostly corporate debt. So corporate debt is like corporate bonds, and they also mix in some dividend stocks, in Canadian dividend stocks as well. The sectors are mixed, but this one focuses primarily on corporate debt. So a good way to get some fixed income exposure here. The next two are from Brompton Funds. So these two focuses mixed sectors. So you have a bunch of different sectors, and they are Canadian dividend stocks. So these two have a lot of the same companies. They're almost identical. This one here is a little bit higher yield, but because they have a couple of extra, smaller cap companies in Canada. So but they're pretty much very identical, and they have the same function to give you exposure to dividend stocks in Canada. The next ones are from a company called Brookfield, a really, really big company. The only downside to this one is that their dividends are quarterly instead of monthly. Not much of a big deal. So the first one here is called the Global Infrastructure Security Income Fund. So it focuses, like the name says, on global infrastructure companies. So infrastructure covers a lot of different companies. It could be utilities, it could be telecoms, it could be companies that manage anything to do with infrastructure, dams and bridges and tolls and all kinds of stuff like that. So it's a pretty cool fund. Most of it's in the US, and a good chunk of it is in Europe. So really good exposure to global infrastructure companies here. Next one is pretty interesting just because of the the dividend yield is really huge. It's called the Select Opportunities Income Fund. So the sectors that this fund concentrates on is on the real estate and the infrastructure sector, but there's not many stocks in this one. It concentrates more on corporate debt. Um, so it's in the U.S. Most of the companies are US based, and it's a good way to get some corporate debt exposure. Risky corporate debt exposure, I would say. Look at the yield. I mean, it's almost 17%. So this is a really big money maker if you're interested. The next one is pretty cool too. It's called the Renewable Partners Fund. So this focuses on the utilities companies, specifically renewable energy, and this is global. So the US dollar sign here, by the way, is because the dividend is paid out in US dollars, but through the brokerage, when I get it, it's automatically exchanged in Canadian dollars. The next one is called the Brookfield Property Partner, sorry. So same type of deal like the renewable energy one, but this one here is focused obviously on global real estate. Mostly in the US, you have the breakdown here. So a really good fund if you want exposure to global real estate. And good thing about these two funds is they both constantly increase their dividend. So the next two are from a company called Harvest. The first one is called Brand Leaders Income Fund. So this one is mixed sectors. It has 15 top brand companies, mostly in the US. So companies that everyone will know, like Visa, MasterCard, Google, Amazon, Microsoft, Pepsi, Coca-Cola, that kind of thing. So good exposure to big brand US companies. Next one's called the Global Telecom and Utilities Income Fund. So obviously it has utilities and telecom, but global exposure, which is good. So next one is from Strathbridge. It's the Canadian Utilities and Telecom Income Fund. So same type of deal as the previous one, except it focuses on Canadian ones. Next one is from Quadravest called Income Financial Trust. So this is specifically financial companies, so banks, life insurance, anything to do with financials, and it covers North America. Next one is from PIMCO. It's the Global Income Opportunities Fund. So this is purely a fixed income play. Various fixed income securities like bonds, corporate debt, etc. And this is covers the globally. The next one is also fixed income. This focuses on corporate debt in the US, however. It's run by Manulife called the Floating Rate Senior Loan Fund. So these two are really good income funds if you're looking to get high yield from fixed income securities. The last two income funds that I have gives me exposure to gold producers or precious metals. So they're both run by a company called CI Investments, and it's by far one of the best ways I found to get income from gold producers because owning gold producers individually usually produces very little or no yield as they usually don't have a dividend, or if they do, it's very, very small. So a good alternative here if you're looking to get into gold precious metals without one having the risk of owning any individual company and two having the advantage of having a huge dividend every month. All right, guys, so moving on to the ETFs now. So the first ones I have here, quite a few from BMO. So BMO is one of the big six banks in Canada. They have really, really good ETFs. I really like them for that. So the first one is called the Canada High Dividend Covered Call ETF. So this gives you broad exposure to the Canadian market, and this is only dividend stocks. The next one, same type of ETF, except it's in the US. The next one, same type of ETF, it's in Europe. And they actually came out with a new one called the Global High Dividend Covered Call. They just came out with it a couple of months ago in 2020, which focuses on global dividend stocks. So with these four ETFs, you really have a good exposure of dividend stocks all across the world. I really like it. The next one is called the Covered Call Utilities Fund, so pretty self-explanatory. It focuses on the utility sector, 70% in Canada, 30% in the US. The next one is the high yield US corporate bond. So here you have more exposure to the US in terms of fixed income because it's corporate debt. Next one is the US put right. So this is mixed sectors. It only has big cap stocks in the US, and they make money with this fund by writing put options, which is another way to make money with options. So a really good exposure to the US here with these two. So if you're asking yourself, what is this covered call? Well, covered call is basically a strategy where a fund manager uses to boost the income. So not only are you getting the income from dividends, but you're also getting income from capital gains because they trade options on this fund. So that's why the management fee here is a bit higher than your typical ETFs. It's because they're managed a bit more, but honestly, I'd rather pay a tiny bit more fee for nicer, juicier yields. So the next couple of ETFs are from a company called Horizons. First one is called the Enhanced Income International Equity. ETF. So this is mixed sectors, and this is non-North American. So a really good way to get exposure, non-Canada and non-US exposure, so international companies. Next one is one of my favorite ones. It's called the Marijuana Life Index, Sciences Index. So this is by far the best and easiest and safest way to get exposure from the cannabis sector, which is, it's pretty hot sector right now. It gives, as you can see here from the money I put in, so it gives a really nice dividend. Although the companies, the cannabis companies don't give a dividend because the fund is really well managed and they make capital gains in the fund, and that's where your distribution or your dividend comes from, capital gains here. The only thing about these ETFs here, and you can see here I have highlighted in blue, that the dividend will vary month to month, quarter to quarter, depending on how much money they make every month. So the third one from Horizon is called the China High Dividend Yield Index. I've been wanting to get exposure to Chinese stocks or Asia stocks for a really long time, and this is one of the best ways that I found in order to do so. So this focuses only on dividend stocks in China, and it covers mixed sectors. So a really good way to get exposure to the Chinese market. The next two are from CI Asset, the same company who did the last two precious metals income funds that I showed you. So CI First Asset, CI Investment, pretty much the same portfolio of companies. So the first one is the Tech Giants Covered Call. This is a great way to get exposure to the technology companies. Most of them are in the US, of course. And the next one is the Energy Giants Covered Call. So this gives you exposure to the energy sector. And what I like about this one, if you don't like the Canadian energy sector, this is purely US and international. So if you want to get involved or get into the energy sector but don't want anything in Canada, this is a good way of doing it. The next one is from Brompton. It's a global healthcare income and growth. So this focuses primarily on the healthcare stocks. Obviously, most of them are going to be in the US and Canada. Sorry, in the US and Europe, because in Canada we don't have much healthcare companies. It's all run privately by the government. Next one I really like from Middlefield is called the REIT Index Plus. So this is purely real estate. So it has a bunch of different REITs or real estate investment trusts in the company in this ETF, sorry. So 70% in Canada, 20% the US, and the rest is international. So another good way of getting exposure to global real estate, but especially in Canada. And the next one is a new fund I recently discovered. I didn't invest in it yet, but I'm planning to. It's called the Hamilton Australian Financials Yield. So this is the good way to get exposure in Australia, and it focuses on the financial and real estate sector. So this is a fund that I recently found, which I'm going to be investing in soon. It's from Hamilton. All right, guys. The next set of funds are called split corporations or split share funds. So, what are they? They're very similar to ETFs and income funds, but they work a bit differently. As you can see here from the breakdown, they have a special place in my heart because they generate almost a quarter of the dividends I get every month. So how do they work? Well, it's pretty. It could be a bit complicated to explain. I'll probably make another video just on split corporations, but just to make it really short, it's called a split corp because there's two classes of shares. You got your preferred shares and you have your regular shares. So the preferred shares are funded by the dividends from the companies in the fund, and the regular shares are funded by the excess dividend plus a bunch of active investing techniques that the manager will use to make money for the regular shares. So the dividend in terms of dividends, the preferred shares are much lower, they have much lower yield, except they're safer, and the regular Class A shares, they're technically not guaranteed, but the yield is very, very high. All right, so the first split share corp I have, and this is the crown jewel of my portfolio, is called the Dividend 15 Split Corp. This is from a company called Quadravest. They make the best split share corporations, by the way. So in there, it's called Dividend 15 because there's 15 companies and they all give a dividend. They're all big cap dividend companies in Canada. So a really, really safe one because of the companies in the fund. These guys have been doing it since 2004, and I think they never missed a dividend payment until this month. Because while I'm making this video, there's the coronavirus stock crash going on. So these guys have been paying a dividend, I think 192 consecutive dividends, so almost 15 years of not missing one, and I'm sure within a month or two they're going to start giving it again. So this is where the trade-off happens with these split corporations. You're getting massive yield, as you can see here. But if there's a big market downturn, even if it's in the short term, they won't be giving the dividend. But I'm very confident that in this one, a month or two from now, they'll start giving it again. The next one, also from the same company, is called Financial 15 Split Corp. So just like the name says, it has 15 financial companies. 10 in Canada and 5 in the US. So this one also has a humongous yield, even more than the other one, except they've missed a few. I've had this one for about 3 years and they missed only three times. So for my personal opinion, it's very much worth the trade-off of sometimes missing the dividend, not getting it, but you're still getting a 21% yield if they do give it. So it's incredible. The next one is safer, much safer because it only has the big six Canadian banks. But as you can see here, the yield is not as much. It's 10%. And the last one here that I have from Quadravest in terms of regular ones is called XTD. This one only has TD. So this is a good alternative that I think it makes sense if you want to get shares of TD, but you want more yield. Well, you're getting about 9 or 10% here instead of the 4% that you're getting just owning shares of TD outright. The last two I have are I actually have the preferred shared ones, so they both give me exposure to life insurance companies in Canada. So this one here, Canadian Life Split Corp, has the big four Canadian life insurance companies. and the M Split Corp has the biggest one, which is Manulife. So these two are a really good alternative if you want to get into if you want to invest in a safe life insurance or health insurance companies in Canada. It's a good way of getting, 6 and 7% instead of 3, 4%. The next three are from Brompton. They have some really good split corps as well. So this one is called LBS, the Life and Bank Split Corp. So this combines the big six banks with the big four life insurance. Pretty smart. I really like this one. Hence, I invested 15,000 here. Really, really good yield of 17%. This is because I recently picked some up really cheap during the stock market crash, coronavirus. The next one is a split bank corp. It only has the big six Canadian banks, so not as much yield, but much safer. And the one I like the most from them, the second best one I like is the GDV. So this is the Global Dividend Growth Split Corporation. So finally, a split corp that gives you some international exposure, not only Canada. The next one is from Strathbridge. This is called the Premium Income Corp. Also one that only has the six Canadian banks. And out of the three split corps that only have the six Canadian banks, this one is the one that has the highest yield. The only caveat is that they give their distribution quarterly. But they've been around for a really, really long time, 1996, and I've been paying their distributions, no problem. The next one is from Middlefield. It's called eSplit Corp. So this one is it has just Enbridge stock in here. So Enbridge is the number one. It's the biggest energy company in Canada. It's a good way of getting exposure to that company, but getting more yield because Enbridge gives a dividend of about I think it was 5 or 6% normally. So here you're getting double that, and it's relatively safe. Cool thing about this one is they recently raised, I don't have it here because I didn't catch it in time, but they recently raised their dividend. And the last one I have is from Harvest. It's specifically for the healthcare sector. So you have the 10 biggest pharmaceutical companies in the US. So a really good way to get big yield with a pretty safe and high paying sector of the market, the US healthcare sector. So here, as you can see here, 9%, so pretty good. All right, so moving on to REITs or real estate investment trusts. I really like REITs. I went crazy and bought a whole bunch of different ones. They make up 17% of my portfolio and 14% of my income. So I'm not going to go through each of them one by one. A lot of them, the first couple of ones here, concentrate on commercial property, which could be retail, it could be office, it could be a mix in Canada. So I just went nuts kind of on the REITs because I really fell in love with them. So I bought as many different ones as I can. So all of these ones here concentrate on the commercial real estate in Canada. This one here, Smart Centers, it's a really big one, and they recently raised their dividend, which is good, as well as this one here, by the way, Firm Capital, another really good one. They have not only commercial but also a bit of residential in Canada. So these two, RioCan and Plaza, focuses specifically on the retail sector in Canada, so stores and strip malls and whatnot. This one here is the next two here are exclusively office buildings, office real estate. So this one here is in Canada. It's one of the only REITs that I had that actually reduced their dividends. They reduced it in March of last year by 46%. I can't say I'm surprised because the yield was 12%. So anything over 10% is pretty high for a REIT. So they reduced it, but I'm still making 6% here. Not pretty good. The next one I really like. I think it's cool because they have office buildings in Europe, in France. I think they have them in Austria. So a good way to get some exposure in those international markets. The next one, automotive properties, is like it says it is. It's just automotive car dealerships all across Canada. So pretty cool to have this one. H&R is one of the biggest REITs out there. It has mixed properties, so you're getting a bit of everything, and not only Canada but also US. So this is definitely one of the biggest REITs on the TSX. The next one is Artis REIT. So this is a big REIT as well, but I ended up buying the preferred shares. Just wanted to see how it would be owning individual company preferred shares, because the yield was a little bit more than the REIT itself. So I'm getting about 6%. The only thing with the preferred shares here, you're not getting it monthly, you're getting it quarterly. Next one is a good one. It's focuses on healthcare facilities all across the world. So this is the Northwest Healthcare Properties one. Really, really stable in the good exposure if you want access to healthcare facilities like old folks' homes, surgical centers, medical centers, etc. The next two focuses on the US exclusively, and that's why they both give their dividend in US dollars. So the first one is the Slate Retail. I really like this one. It focuses on commercial, and they have a good record of increasing their dividend once a year, as you could see here. The next one has been really, really hit hard due to the coronavirus. And it makes sense because this company only has hotel properties. So with the travel bans, it makes sense that they're struggling right now, and they actually not only recently reduced their dividend by 30%, so which I kind of agree with because it was at about 11, 12%. Now it's at 6.6, so it's a lot better. But they also temporarily suspended their dividend because of the coronavirus. So for this one here, I'm going to keep it for sure just because they suspended their dividend. They said it was temporary. I'm sure that once all the bans get removed, the dividend is going to be reinstated. All right, guys, so it's time to go over my individual companies or businesses, what I like to call regular stocks. So they make up 42% of my portfolio and 36% of my income, so a really big chunk. So starting with the consumer stocks, I have KP Tissue. They own a bunch of the tissue paper brands in Canada, the premium ones. Their parent company is Kruger, so brands like Cashmere and Purex, if I'm not mistaken, Scotties, things like that. Game Host is interesting. I got this one mostly for fun. They own three casinos and hotels in Alberta, so most of their money comes from casino revenue. So one of the rare opportunities you actually have to get a piece of a casino. Pretty cool. Unfortunately, they had to suspend their dividend because they had to close their casinos due to the COVID-19. The next ones are the restaurant chains I have. So I have Pizza Pizza, Boston Pizza, The Keg, and Jack Astor's Scatterbush, which is under a company called SIR Royalty. So three out of the four are have a .UN after it. That's because technically they're investment trusts, just like REITs. So these guys all give a dividend every month. Unfortunately, Boston Pizza and SIR have suspended their dividends temporarily, but I'm sure that once the restaurants reopen, they'll start giving it. So pretty good yields with these restaurants here. So the next section, sorry, is my energy companies. So I won't go into detail on each one. The first four I have are Whitecap, Arc Resources, Vermilion, and Freehold. These are the oil and gas exploration and production companies. So these, in terms of risk, are the highest risk because they basically go up and down with the oil price. Uh, Vermilion Energy has probably been the biggest disappointment in my whole portfolio simply because the dividend has been completely annihilated. So they cut it by half in March, and then they cut it again 82% in April. This is because of the coronavirus. So right now, as you can see, it's the fund generating the lowest amount of yield for me. I'm gonna keep it though because I'm really down on it right now. So there's no point selling it. It makes no sense. I'll keep it and hopefully they raise their dividend. The big advantage with Vermilion, however, is that they're an international company, so not just Canadian. My favorite one, though, by far out of the oil and gas exploration is Freehold Royalties. I love anything with royalties in the name because the point is to give dividends to its shareholders. So far, they haven't announced any dividend cut. I am expecting one, but we'll see what happens. The next one is called Mullen Group. So I put this part of the energy section here, but they specialize in trucking and logistics. So transportation, but because they do the transport for oil companies, I decided to put it in the energy sector. The next three are the midstream energy companies. So these are a lot safer. They tend to be dividend aristocrats and very safe because they're basically the middlemen. That's why they're called midstream. So they take care of the transportation and the processing of the oil, things like pipelines and things like that. So Keyera, Interpipeline, Enbridge. Enbridge, by the way, is the biggest energy in Canada. All three of them are dividend aristocrats. So these ones I would strongly suggest going for the midstream companies if you want to invest in the energy sector because they're safer. Okay, so financials now. It makes sense. A lot of the companies, my individual businesses, are part of the financial sector. So the first three are banks. You have Laurentian Bank, which is not one of the big six in Canada, but it's a small bank, but still a really good one, a really old company, dividend aristocrat, and they do business mostly in Quebec. The next two are very well known. It's the number three and number five bank in Canada, CIBC and Scotiabank. So out of the six big banks, these two, CIBC and Scotiabank, have the highest yields. That's why I bought them individually. And as you can see from all the green here, banks are they increase their dividends a lot and constantly. Alaris Royalty Corp. I really like this company. Again, with anything with royalty inside the name, I really like. So these guys provide financing to Canadian businesses. So smaller, medium-sized businesses go to Alaris for financing in exchange for royalties that they get, and in turn, Alaris gives the royalties to us, the shareholders, in dividends. So really, really good yield. They also keep increasing their dividend. So really good sign. Crown Capital Partners is very similar to Alaris. They also provide financing to Canadian businesses. Automotive Finco is a bit smaller. They provide financing to car dealerships. Chesswood Group is an acquisitions company, so they buy or own several companies that provides financial services to businesses. So well diversified because they have more than one company. Really good dividend yield, very stable as well. Mosaic Capital, same type of deal. They're an acquisitions company, so they buy out Canadian businesses and have a big portfolio of businesses. Diversified Royalty is one of my favorites. Also have a royalty in the name. So what these guys do is they buy the trademarks or royalties off businesses, and they provide the shareholders with dividends from those royalties. So they own the Mr. Lube chains, Sutton, which is a big real estate broker company. They own the Air Miles trademark and a bunch of other ones. The next ones are my mortgage companies. So I really like mortgage companies just because they're very, very safe. So these companies are financial companies that specialize only in mortgages. So yes, banks do it too, but because these guys only do mortgage, the yield is higher than banks. So a good alternative for safe income. If you're comparing them to banks. So Atrium, there's First National Financial. This is the biggest one by far. Firm Capital, and then you have McCann. So as you can see, a few of these have raised their dividend, which is a good sign. Then you have a bit of the two other ones I have here, the riskier ones because they deal with short-term commercial and short-term residential, but because they're riskier, the yields are a bit higher. So the next ones are my wealth or asset management companies. You have Investors Group, which does purely asset management, and then you have Great West Lifeco, which is one of the four biggest life insurers in Canada. So they also do asset management. So these two are actually cousin companies because they're owned by one giant corporation called the Power Corporation of Canada, one of the oldest dividend aristocrats in Canada. I think they've been around for like 100 years, and these guys all pretty much keep raising their dividend, which is good. Then I have Fiera Capital Corporation, another wealth management company in Canada, not as big as Investors Group, but their dividend yield is really good, and they too have been raising it, so a really good sign. All right, so the next section is my healthcare companies. I just have three here. Medical facilities, they own surgical facilities in the US. I'm pretty disappointed in this one because the dividend was really good, but they cut it, and the cut was really brutal, 75%. So I'm only making 3.68% on this one. EXC or Extendicare, a much safer one. They own senior healthcare properties all over Canada, a lot of them with government contracts, so a really safe one here. But my favorite one by far is called Invesc. They own senior healthcare facilities all over North America. It's a US company, that's why they give the dividend in US, but the yield is really, really good. I recently picked some up because of they were cheap, and now I'm up to 11% yield. Next one's my industrial and materials company. So Decisive Dividend Corporation, I mean, to have dividend in the name of your corporation is great. It definitely attracted me to this one. So they are an acquisitions company. They acquire manufacturing companies, really good one. Exchange Income, so they're also an acquisitions company, but they deal with the aerospace and aviation company. So this one has been hit pretty hard recently because of the COVID-19, but it's a dividend aristocrat. So I strongly suggest to pick this one up ASAP. Chorus Aviation, these guys provide a regional aviation solutions. So their main partner is Air Canada, the biggest airline in Canada, who I work for. And yeah, they basically have a fleet of planes that they lease out to bigger airlines. Bird Construction, I do have a little bit here. They provide construction services, so it's a construction company basically. Supreme X, these guys make envelopes and packaging products, so they're a manufacturer. Pretty small company, but they're actually local in Montreal where I live, so which is pretty cool. Russell's Metals is a steel distributor and processing giant, so they deal with anything to do with steel. Chemtrade Logistics Income Fund. So this also is an individual business, but technically an income fund or an income trust. That's why there's the .UN, and they deal with industrial chemicals. They have a long, long history of providing a good monthly dividend. Unfortunately, they cut it in half recently just because of they say it's uncertainty because of COVID-19. So I have a feeling they might increase this one back. But as you can see, even with the dividend cut, I'm making over 5%, which is not bad. Canwell Buildings Material, these guys just provide construction and buildings materials to construction companies. Acadian Timber, I really like. They do anything to do with forest products, mostly lumber. They have a good history of raising their dividend as well. Next to, so it's the individual telecom companies that I own. It's Bell Canada, of course, is the number one in Canada, and the number two is TELUS. So these guys are obviously dividend aristocrats. They keep raising their dividends, which is normal for telecom companies. They're some of the best as companies, best sector to get. Utilities, so I have a couple mostly in the renewable energy sector. So utilities, very, very safe, very, very stable, but the dividend yield is, is a bit lower. So you have TransAlta Renewables. I have Capital Powers. They both specialize in renewable. Superior Plus, these guys specialize in propane. Pinnacle Renewable is a pretty interesting company. They produce wood pellets. Apparently, that's renewable energy, so that's pretty cool. And then you have Polaris Infrastructure, which is good if you want exposure outside of North America, as these guys have renewable utility projects exclusively in Latin America. Bridgemark Real Estate Services. So this is a company that owns three famous or big Canadian brokers: Royal LePage, Via Capital, and there's a third one. So the only company I have that has to do with real estate that's not a REIT is basically this one. And last but not least, it's a small technology or IT service provider. It's called Pivot Technology Solutions, and they give a pretty nice dividend. All right, guys, so that's the end of the portfolio. Finally, you have the grand totals here. So the total amount of money I have invested is $628,000. My average annual dividend yield is 8.51. So in total, in Canadian, I'm making about 53,000 a year, or 4,400, 4,453 every month. So thanks a lot for watching, guys. I really appreciate it. If you're interested in having my Excel file so you could use it in any way, shape, or form, check out in the description. I'll make it available to you. Also, if you're wondering what my journey or my timeline was to get to this point, check out my other videos where I actually have one on my our timeline. And if you're completely new to investing, I also have a 5-part video series on how to invest and how to get started if you're completely new to this. So thanks again for watching, guys. Please hit the like button and subscribe. I would really appreciate it, and see you next time.